if you look at a graph of China and their treasury holdings versus their gold accumulation, it's like this. They're dumping treasuries as fast as they can to not cut off their nose to spite your face. And I would argue this is part of the reason that rates are continuing to stay elevated, is that a lot of these countries are selling debt. And you look at the countries that we are supposed to believe are now leading the accumulation of our treasuries. You got Ireland, you got the UK, you got the Cayman Islands. I mean, I got a bridge to sell you if you believe that's true. Guys like Jim Willey have the courage to come out and say that he believes and has, heard from his sources that the Federal Reserve is paying money under the table of these countries to continue to support, and of course, with the carry trade unwinding, there's a lot of things going on right now that I think if you cut, you signal, you really signal that you're waving the white flag. And I think that only accelerates the cohesion and the rapid growth of, the organizations like the BRICS, and the continued de-dollarization and de-treasurization, which I really do believe is being replaced right now with gold.
Amid the backdrop of global economic turbulence, Andy Schectman highlights a critical financial move by China, shedding light on an alarming trend. China has been offloading US treasuries at a record pace, while simultaneously increasing its gold reserves. This shift is starkly evident when you examine the data. China's treasury holdings are plummeting, while their gold accumulation skyrockets. To put this into perspective, the amount of US debt being sold off is staggering, highlighting a strategic move to reduce dependency on the US dollar. Schectman argues that this is part of a broader trend towards de-dollarization, with countries around the world seeking to protect themselves from US economic policies. The implications for global markets and the US economy are profound, signaling potential instability and increased volatility.
And the only thing that sticks out to me is the realization in terms of monetary policy and fiscal irresponsibility that we are creating $1 trillion of debt every 100 days, and when you talk about just how big that is, well, it took almost 200 years to accumulate the first $1 trillion. Trillion seconds ago is 31,688 years ago. And when you talk about, the ability to continue to create that much debt in an environment where, you could argue our policies are not really being embraced around the globe. I think it's for me, that's really what stands out from a monetary policy, is just the ever increasing amount of debt creation, of spending, irresponsible fiscal policy. To me, that's really what I see on a macro perspective. There's a lot of periphery out there that can distract, but just looking at the amount of spending coming out of the government, or the number of auctions, we just had $70 billion in 5-year U.S. Treasury and $70 billion in 2-year U.S. Treasury notes, and that, you got $244 billion in Treasury debt on top of that. That's just hitting now the market. And so when you talk about monetary and fiscal policy, to me, it's just about irresponsibility, massive money creation, and I don't think it ends well. This is not something that I think is a recipe for success moving forward. Yeah, I don't think that. I mean, I've been saying all along, I don't think that they're going to cut. It's one of these deals where if they cut, inflation is going to roar. And everything they've told us, it has been the opposite of what they've told us. Go all the way back to, well, there is no inflation, and then it's transitory, whatever the hell that means, and then it's structural, but then it's under control, but then it's reared its head again. We're going to do 4 rate cuts for sure, maybe 2. And now you're even hearing guys like the head of the Minneapolis Fed saying maybe we're even going to raise rates. I don't think you can believe anything that comes out of the Federal Reserve's mouth collectively. And I don't see them cutting rates. I think it's higher for longer. I mean, look, when you talk about inflation, when you talk about commitments, look, everyone talks about the nearly $35 trillion debt, but that doesn't take into account, Kai, the unfunded liabilities of Medicare Part B, $99 trillion, Medicare Part D, the prescriptions, $22 trillion. Social Security, 77 trillion. Government, military pensions. Who the hell is going to pay for that? How about the 15 to 17 million people, depending upon which person you listen to in terms of unofficial number of people entering this country illegally? Who's going to pay for their schooling, their food, their housing, their medical? The amount of commitments that we have are extraordinary. So when you talk about reigniting the inflation engine, I mean, it's already here. It's ignited. The amount of money that's been created in the past several years is extreme, hasn't even worked its way through the system yet. So if we do cut, to me, what it really signals to the rest of the world is we've given up on austerity. We've given up on normalizing our balance sheet ever. And if we do cut, I think you can just look for massive reigniting of inflation that becomes far more apparent than it already is by the lying CPI numbers, where they exclude things like coffee, which is up 80% in the last year. Oh, let's pull it out and replace it with tea. The way that they lie to us about what inflation really is bad enough. But I think that cutting is a problem where you're going to have to wonder who the hell is going to be foolish enough to buy our treasuries. And these large amount of treasuries, $1 trillion worth every quarter to finance our addiction to spending. Who's going to take it when we start to lower rates? I don't think that they can lower rates. I think that they are stuck. And usually if you just do the opposite of what they tell you, it pretty much works out to the truth. And then go back and go all the way back to Bernanke saying the subprime crisis is contained, and a few weeks later it blows up. They're not being honest with us. They're not honest with us about any of the numbers that come out of the Bureau of Labor Statistics, nor are they honest with us about their projections of rate cuts. I don't think it's going to happen, to be honest with you. Higher for longer? Yeah, I think that's here to stay. Most of it is created out of the government. You take the government creation out of there, the job creation and the GDP created by the government. I mean, what is it really? I think that it's a joke. Most of the numbers that we see, I don't believe one bit at all. And I think people feel like we're being told everything's okay and a soft landing is at hand. Yet, you take a look at what's happening around you. You got 65% of the country living paycheck to paycheck. 45% of the people that are making over 100 grand a year, over six figures, they're living paycheck to paycheck. So I don't think it's as rosy as people are telling us. And you look at what's going on with the banks and with the commercial real estate and with the economy in general. I don't think the numbers that we are being given and the information we are being given lines up with Main Street. I think people are hurting right now, and half the country can't even afford a McDonald's. So I just think, really, Kai, if there's a major theme here, it's the numbers that we are being told are crap. And everyone points to this strength in the equity markets being held up by a handful of stocks. But in reality, to me, what this is smoke and mirrors. And I think people feel that the numbers that we are being reported really just aren't indicative of how easy it is to make ends meet these days. Yeah, you could argue, and maybe this is why you see the central banks buying gold at record levels that they've never seen before. I mean, it just seems that all of these countries are trapped, and damned if you do and damned if you don't. Currency wars, indeed, yeah. And you race to the bottom. Well, that's not a recipe for success. That's not a currency you want to be hanging on to. But it becomes a bigger problem when you talk about the U.S. bond market. If everyone is racing to the bottom and cutting, what does that say for the ever increasing debt burden that we have? Look, the national debt right now is $34.7 trillion here in the U.S. And if I just read a statistic that says if you laid that money, that many dollar bills end to end, it would wrap around the earth 134,599 times. That's enough to travel the sun and back 17 times. A trillion seconds ago was 31,688 years ago. How do we continue to finance our debt by cutting rates when the world realizes that we have chosen inflation over austerity? And that's really the problem. When you see all of these countries shedding, if you look at a graph of China and their treasury holdings versus their gold accumulation, it's like this. They're dumping treasuries as fast as they can to not cut off their nose to spite your face. And I would argue this is part of the reason that rates are continuing to stay elevated, is that a lot of these countries are selling debt. And you look at the countries that we are supposed to believe are now leading the accumulation of our treasuries. You got Ireland, you got the UK, you got the Cayman Islands. I mean, I got a bridge to sell you if you believe that's true. Guys like Jim Willey have the courage to come out and say that he believes and has, heard from his sources that the Federal Reserve is paying money under the table of these countries to continue to support, and of course, with the carry trade unwinding, there's a lot of things going on right now that I think if you cut, you signal, you really signal that you're waving the white flag. And I think that only accelerates the cohesion and the rapid growth of, the organizations like the BRICS, and the continued de-dollarization and de-treasurization, which I really do believe is being replaced right now with gold. And if you look at gold since 2000 as an example, it's massively outperformed the bond market. But what it has is that it has no counterparty risk. And when we go around the world imposing sanctions and now have the nerve to actually steal the Russian assets, to use it to fund the Ukraine war, and you got the European Union talking about seizing, which we already have, they have the 290 billion or 80 billion in Russian reserves. Now, they haven't talked about actually taking that money as much as they have taking the interest generated from it and using it to fund the Ukraine war. Collectively, the West has lost its mind. And I think when you talk about cutting rates, it will only add fuel to the cohesion and to the rallying cry to move away from the West. I think it would be as foolish as can be. But when you look at all of the stupid things that have been done by the West collectively in terms of geopolitically, it wouldn't surprise me one bit. In fact, the title of my first talk at Rick's conference is this all too foolish to not be planned? You look around, you say, my God, what are they doing? So the people leading the people pulling the strings, to me, are making all of the wrong decisions. So I guess we'll have to see how it all plays out. But yeah, I just can't see them. I can't see cutting being a constructive course of action, and think it only accelerates the demise of the system, and the de-dollarization and the de-treasurization will only increase exponentially if we continue to go down that road.
As we wrap up today's video, let's recap the key points from Andy Schectman's insights. We've discussed China's significant move to sell off US treasuries at a record pace, while simultaneously increasing their gold reserves. This shift highlights a broader trend towards de-dollarization and raises serious concerns about the sustainability of US monetary and fiscal policies. The potential impact on global markets and the US economy could be profound, leading to increased volatility and instability. Thank you so much for watching. If you found this video informative, please hit the like button and share it with others who might benefit from these insights. Don't forget to subscribe to our channel for more in-depth financial analyses. And we'd love to hear your thoughts. Drop a comment below and let us know your opinions on today's topic. See you in the next video.